So I wanted to bring up one more, instrument here to look at, and this is the CME liquidity tool. And what we're looking at here is the E-mini depth of book. And we've shown this before. I think actually you and I have conversed about this before. And you could see that in September, I think a lot of this was interest rate driven when the Fed started talking about higher rates, and liquidity just evaporated. And we look at the price of the S&P today. I mean, we're swinging in 10 handle moves just on nothing, right? We're just flopping around by 10 handle S&P increments. What is it, do you think, that brings liquidity materially back to the market? I mean, do you have an opinion on that? It's kind of a curveball question, but I don't think that we'll get a strong bounce in markets until so much of what is going on right now is liquidity based, right? Who wants to buy not just equities, but who wants to buy MBS and all these other things? This is a structural problem with the market.
Yeah, I mean, I think it's a function of just liquidity being drained out of the system, right? So
Yeah.
they want that, right? They want less liquidity in the system. You've got the guys who analyze that. I think it's cross-border capital talk about liquidity all the time and say how dramatically it's rolling over, right? And whatever measures that they've got a liquidity index that they've built that looks at various things, but yeah, that is a consequence of general liquidity being removed and risk appetite coming down everywhere. And if there's not risk appetite, there's not depth on the bid and offer,
Right.
and that's what you're going to see basically.
Right. So the impact here, for most of you probably understand that, but just to be clear, that if you're a fund, right, and you got to liquidate because of a margin call, or you just need to get some risk on, you got to pay more price, right? You're going to push the S&P price more, the futures price more, to get that equivalent liquidity. So that's particularly scary in an issue with the margin call, where you just have to close out, right? Your bank or your PM or whatever is like, take these positions off, and you're just forced to trade. And that's why you get these cascading defaults. Generally, if you're buying and you want to put a position on, you can wait, right? You can mitigate some of your impact by waiting before you get that risk on. But in these situations where you get a forced liquidations, this is where that liquidity, I think, really hits, and that's where volatility can really gap higher.